$1,000 is enough to start your entire empire. Truly, this is 100% the case. Look at most of the wealthiest people throughout history, and nearly all of them are self-made. It wasn't their circumstances that gave them success. It was them going and getting it. Studying, learning quickly along the way, strategizing, and working hard. One thing preventing new investors from getting started is the idea that they need a lot of money to begin investing. However, that's actually backwards thinking. You start from where you're at today and you progress towards your goal. You want to invest to make money, so don't put it off if you don't feel like you have enough money today. If you want to get ahead financially, you should start with whatever it is that you do have. The good news is that if you get going, you will learn as you go and continually improve your performance, which is the name of the game in all of this. So, how do you get started with $1,000? It's way too easy to give the standard advice here and say, it doesn't matter as long as you start, or you only lose by not playing. However, the actual answer has more to do with where you're at today and your current status. Suppose that you have $1,000 in a standard savings account. You're almost standing still if that's the case, letting the inflation rate alone overtake the interest that you're getting from the bank on that account. Depending on your financial goals and resources, you can decide how you want to improve on that performance way beyond what you'd get from a savings account. So here are some helpful ways to develop and build your investment strategy for the long haul. First, you need to consider what your financial goals are. If you're saving for a particular event or purchase, your approach is going to be different than if you're looking to generate wealth for generations. The reason is that you may have a deadline or a short-term goal for the money. Maybe it's that you have a wedding or a vacation, or that you want to turn that $1,000 into $3,000. But on the other hand, if you're building a retirement account for yourself, or you want to think big picture for multi-generational wealth, you probably have a much longer timeline to both consider and to invest and get returns. My advice at this stage is legacy. I know I've said this in many other videos, and frankly, we even have a podcast with the name Legacy, aka the Health, Wealth, and Legacy podcast that we have on Spotify. But the point is, you know that legacy is the number one most important thing to me. So in this instance, I'm going to say the same thing. Think long term and focus on building wealth is my advice and my experience. This helps the focus to be on the big picture and the long run instead of the small things along the way and things that are actually very minute when you consider the overall market conditions of a long period of time. But that said, once you determine what your goals are, the next step is to evaluate your risk tolerance and appetite of your investing. Deciding how much risk to accept depends on your financial goals, like we talked about in the previous section, as well as your current resources and just generally your outlook and your personal disposition, who you are as a person, and how those risks affect you individually. But the reality is, most often, to reach aggressive financial goals and to get to those goals more quickly, you must accept a higher risk of your investment and the potential of even losing it 100%. On the other hand, if you can't handle the thought of losing your capital, or you're older and you actually don't have the time to take a larger loss along the way, you should proceed much more conservatively, especially if you're doing the investing on your own and not with a pro or someone that does this day in and day out. At this stage, it's worth mentioning that stocks are going to be among the riskiest investments overall, especially if you're buying individual stocks. Bonds, on the other hand, are far less likely to result in a loss, but you're not really going to grow your money as quickly as you could in other areas. Typically, the safer the investment, the less opportunity for profit you're going to get. That's why experts recommend spreading your assets across a wide spectrum of options to reduce the overall risk while you are still allowing the opportunity for growth. This is diversification in a nutshell. For me, real estate has always been and will likely always be the best wealth building tool in my own personal strategy. I can say from my experience, the sooner you can invest in real estate, the larger the rewards. And if you do it properly, the diversification is amazing and hedges the risks significantly. All right, the next consideration is how much involvement you want to have in the investment. Do you want someone else to decide what you invest in? Well, with $1,000, you probably can't afford a human advisor that's going to be super hands-on, but you can choose a mutual fund or a robo-advisor. Mutual funds often charge low fees and may even provide great returns. One of these options might work best if you prefer a hands-off approach, but index funds, for example, try to mirror the performance of a stock index, an entire index, like say the S&P 500. If you don't feel comfortable choosing individual stocks, which most people shouldn't because there's a ton of work that goes into that and there's a huge, bigger risk also associated with that, then I personally can recommend taking a look at ETFs or full indexes like the S&P 500. Multiple experiences and studies show that this is a wise strategy for beginners, and even most seasoned investors need to have index-wide protection and that kind of diversity in their portfolios. Some funds with robo-advisors offer very low entry point for investors. If you start with that $1,000 but have, let's say, $100 more per month to be added to that account, you may save on administration fees as well because there might be specific deals with that fund or ETF, so it's worth looking into to save a few bucks on fees. Next, you must consider diversification. It is definitely possible to take that $1,000 and invest in a random inexpensive stock that you have good feelings about, right? You just know it's gonna work. And there is a chance that you can watch your money multiply as if you had bought Microsoft right when it went public and took that ship straight to the moon. Unfortunately, it's also possible that your $1,000 may disappear altogether. I mean, let's take crypto for example, which is gonna be the easiest example of hit or miss. 1 year, every Dogecoin investor is a freaking genius getting thousands of % returns on their investment. And literally the next year, the entire industry tanked completely and most coins went to zero. So the point is, if you have limited resources, it's better to spread the money around because that's what it is at the end of the day. If you're putting all your eggs in one basket and there's no diversification, oftentimes that's a bet and a speculation more than a strategy. Again, a mutual fund or an ETF or even a well-chosen REIT is typically going to offer more security and the potential for higher returns with often a great amount of diversification built into those investments. And the next point to think about in your investing career is don't overlook real estate. No, you probably can't buy a rental property with $1,000. However, you can use that $1,000 to get started in real estate if you want to. Can you use $1,000 as a down payment? Again, probably no. But on the other hand, even with that $1,000, you can buy into real estate backed investments. You may be able to buy a share in a real estate syndication or even join a tenancy in common investment group. Additionally, there are real estate focused mutual funds and REITs. These mutual funds and REITs expose you to real estate and you can learn some of the basics along the way while investing in groups that are then investing in real estate. But without a doubt, the number one way to invest in real estate is when you build up the capital to consider real estate funds and syndications. To me and in my investing career, these are literally the pinnacle of entering the real estate investment world, and they've paid me the most along the way, hands down, the highest returns and the highest protection I have personally received. The next piece of the strategy is don't invest your freaking rent money. Never ever gamble with money that you can't afford to lose, because even the safest investments can go belly up if there's a horrible turn of events. The reality is there's no such thing as a 100% sure bet. However, there are things that are much surer bets and safer bets than others. But it's critical at this point, especially if you only have $1,000 to invest, to not risk your financial stability as you pursue profits at this stage. If you do have debt, aside from maybe like your mortgage or other essentials, make sure you are taking steps to minimize this debt along the way before you go and invest that $1,000 elsewhere. Also, I recommend building an emergency fund, at least 3 months of expenses that you can live off of. This provides a cushion in case you need it, and what it actually does on a bigger picture, it lets you be a more confident investor, knowing that the timing of your investments do not have to pay off for you to make your bills. If there's a huge crazy change in your life, like a loss of income or a global pandemic, which we went through, or some other thing that you have not foreseen, your emergency fund is literally a lifesaver. The next thing to do is take advantage of advantages, baby. That might seem obvious, but so many people are not even taking advantage of basic things that are sitting right in front of them. Things like maximizing contributions to your 401k company-sponsored account. Guys, these are freebies. You got to take advantage of those, especially if it's company-sponsored and they're willing to match a portion of that for you. And just a reminder, you're not going to find very many options to beat great strategies like investing your pre-tax income into a 401k or similar offerings. Of course, this is not the best vehicle if you have that short-term need like we talked about earlier, like a trip or a wedding or etc. But for a long-term goal like retirement especially, this is an amazing strategy that you can draw on with huge benefits to you. So in short, take advantage of any matching opportunities that your company may have for you. But again, for me personally, the goal is to get to real estate. One of the biggest advantages investing into real estate strategically is getting the multiple benefits that the asset class has for you along the way. This is going to be different for each person, but here's some of the top ones. Cash flow, flexibility, or even the tax benefits that go with a ton of different real estate investment options. So what I'm going to do for you guys here is put up a link to a great discussion we posted outlining the top 5 considerations for investing into real estate today, as well as some of the best benefits that you can incur as well. It's a short video, but it gives some really good insight for you onto the investment options that are available in the real estate world, so you can balance your investment decisions with some diversification and you can make the best choice for you. Check it out.